Hi, welcome to Slay the Spider. I'm Jim B, and I'm the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. There are three major influences on the movement of stock price, according to a study by Benny King. 80% of your investment success will be due to the movement of the sector and the market. Now you can view a weekly snapshot image of the market and the sectors. This is a snapshot from April 9th, 2021. The red arrow, pointing towards the 2 o'clock position, represents the market. The rectangles each represent a mini-sector. They are color-coded to the sector they represent. Healthcare mini-sectors are in red, technology is dark blue, financials are green, media communications are brown, industrials are purple, consumer discretionary are light blue, and all the others are gray. I've been charting this movement since 1998 over more than 25 cycles using this exact mix of 40 mini-sectors. The key to understanding the movement and what makes the cycle predictable are the psychological stages that investors experience as they go through complete market cycles. It rarely changes. These stages are on the outside border of the circle. The placement of the sectors and the market are completely data driven. The interpretation of what to expect next is from my experience of going through the cycle dozens of times. I'm not always perfect, but the beauty of the circle is that it corrects me quickly when I don't get my prediction absolutely correct. I've learned it's okay to be wrong now and then, but absolutely abysmal to stay wrong when the data says otherwise. This week we had one sector move from the bearish side to the bullish side. It's the smallest mini sector, protection and safety, which has a grand total of 27 members. Two stocks went to buys and moved to the entire sector positive. No big deal at all. We had six mini sectors move from bullish side to the bear side. They were drugs, semiconductors, Wall Street, household products, aero defense, and transports. First, in the health sector, the number of stocks on buy signals in healthcare and drugs both declined this week, while biomedical stocks stayed stable. Drugs moved into bear country. In media and communications, all three mini sectors, internet, telephone, and media, all declined. In technology, all the mini sectors, semiconductor, software, electronics, and computers declined, and semiconductors crossed from the bullish side to the bearish side with a significant decline. In consumer discretionary mini sectors, household products, the last consumer discretionary sector in bull country, crossed to the bear side and declined. Leisure and retail both declined, and restaurants had the biggest drop of any of all the mini sectors. In financials, finance declined substantially, while Wall Street declined and crossed from bull side to the bear side. In the industrials, metals, steel, and machinery tools declined, waste management rose on the bullish side, and aero stocks declined and crossed over into the bear side. In the others group, precious metals and textiles declined, electric utilities rose slightly, oil services and oils and gas utilities also dropped. Transports declined sharply and crossed into the bear zone. Even as the Nasdaq, the Dow, and the S&P are at or near highs this week, just three mini sectors remain unchanged. Six rose and 31 mini sectors declined. This looks nearly identical to the dot-com market top 21 years ago with one major exception. The dot-com bubble was led by tech. This bubble was led by biomedical and drugs due to the pandemic. The biomedical and drug stocks got hammered in February, with many still down 50% or more. In the dot-com era, I sold the internet stocks when the internet sectors turned down. I got out less than 3% from the very top. About 10 days later, I sold my semiconductor stocks again when the mini sector started down. I sold and got out very near the market top. Overall, this week, the market score dropped from 79 to 71%. Since the NASDAQ peak February 12th, 1,031 stocks have gone from buy signals to sell signals out of my universe of just over 6,200 stocks. That's over 16% of all the stocks in my database. This means the weaker companies are selling off first from our market tops. This is normal and one of the keys I look for internally in the markets. Last week I said that we can expect next in many sectors crossing from the bull side to the bear side. The bear sectors went from 20 to 15, a quarter of the bullish mini sectors, even while the indexes hit new highs. Banks are also very close to going to the bear side with just over 3% going to sell signals this past week. The administration has proposed raising the corporate tax rate from 21% to 28%, which is a 33% increase. This is going to lower earnings, and as a result, the price to earnings ratio is going to go higher. It's now over 42, and just from this tax change, headed over 50. Bank of America says $579 billion moved into equity funds over the past 5 months. That's over $115 billion per month. It's a massive increase. Compare this to the net deposits of $452 billion over the entire past 12 years, or averaging about $11.3 billion per month. Pre-pandemic, the largest inflows to funds in a single month was January 2000 at about $65 billion. Over that previous 12 years, NASDAQ went up 857%, and the S&P was up 363%. Over the past 5 months, NASDAQ went up 14.8%, and the S&P gained 15.6%. Today, Monday, April 26th, I believe NASDAQ just went over its February 12 high. And meanwhile, over the past 5 months, from the highs, 1,031 stocks went down and gave sell signals, and the percentage of stocks on buy signals declined from 79.3% to 56.9%. This is a comparison of what the Slay the Spider chart looked like on January 15th compared to today. This is what happens as 1,031 stocks go from buy signals to sell signals. The $579 billion has kept the market indexes high, but the overall weakness of the stock market is clearly shown in the comparison of these two charts. I expect less than half of all stocks will be on buy signals at some point in May. Paid subscriptions are now available. They're $15 a month on a month-to-month basis, $144 a year, or $12 a month on an annual basis. And we have a 90-day free trial, no credit card required. Thanks for watching my Slay the Spider video this week. For those of you who are new, so far this year we've gone through about 8 of the events on the Slay the Spider Circle, and I called all 8 of them correctly. And for those of you who watched everything since January, you're welcome. See you next week. Thanks.